In this video, I will go over the nature and the role of the money market. The money market was introduced in the earlier section, the nature of financial markets and institutions. Please go back and review this section now. The money market is the global financial market for short-term borrowing and lending. Investments tend to last up to 12 months. Companies and governments issue short-term debt on the money market. They are considered to be secure investments, so offer a low rate of return when compared to the returns offered by long-term investments on the capital market. On the money market, the following can be traded: Treasury bills, commercial paper. These are short-term unsecured debt issued to fund short-term debts of an organization, like trade receivables, bankers' acceptances. Another short-term debt instrument that is guaranteed by a commercial bank, similar to a treasury bill. The money markets provide an important role for public and private sectors. Firstly, by allowing private and public organizations to raise short-term cash for liquidity. For example, to fund short-term payables such as inventory or payroll expenses while they are awaiting cash, for example from the sale of said inventory. These investments are also considered very liquid by investors, so attractive as short-term investments. Companies need to have liquidity in their organization to enable them to speculate, so take advantage of opportunities for emergencies and for their normal transactions. The money markets enable this by offering liquidity and short-term trade finance. The money markets also allow organizations to manage their exposure to foreign currency risk and interest rate risk. Managing foreign currency risk is covered in managing exchange rate risk. Please look at this section to understand how organizations can use the money markets to reduce foreign exchange risk with forward contracts, futures, and options. Managing interest rate risk is covered in Managing Interest Rate Risk section, where this risk can be managed using futures and options, types of derivatives that are available on the money markets. So, the money markets offer very important services. But what are the financial institutions' role in the money market? They act as financial intermediaries. Their role was examined in an earlier section, the nature and role of financial markets and institutions. I advise you have a look at it now. The main advantages of the financial institutions is they reduce the cost of the transactions. On an individual level, this would be very high, but financial institutions have large volumes of transactions, so they reduce the transaction costs of the money markets through economies of scale. They can reduce credit risk. For example, an individual with $200,000 to invest will have to engage a specialist or many specialists to assess the credit risk of various investments options. This will be costly and will quickly eat into their investment monies. A financial institution often has access to these specialists in-house and has experience in investing in specific areas, so can produce more credit risk information at a cheaper rate, reducing this credit risk to the investor. Banks and other financial institutions can also convert their illiquid assets into marketable securities and sell them on. These are usually attached to an underlying asset. This is advantageous for the financial institution. In recent years, financial institutions have received a lot of bad publicity for this practice, particularly in countries affected by the recent mortgage crisis. Illiquid assets, such as long-term loans like mortgages for personal homes, can be grouped together and sold as mortgage-backed securities. These are long-term loans backed by the asset, a person's home. The investor who buys this security from a financial institution has the security that if the borrower defaults on their loan repayments, they can sell the underlying asset, i.e., an individual's home. These securities were traded internationally and caused political tensions when homeowners realised that their debt was sold onto an international institutional investor without their knowledge. This conversion of illiquid assets like long-term debt to a marketable security is called securitization. Now you have a clear understanding of what the money markets are. Let's look at what is commonly sold on them. They can be divided into the following categories: interest-bearing, discount instruments, and derivative products. Interest-bearing products are any products that bear an interest to their owner. Examples of these are certificates of deposits, which are abbreviated to CDs. These are certificates for amounts deposited with a bank for a specific time and rate. There are two types of certificates of deposit. They are negotiable, meaning that they can be sold by the bearer before the time is up, i.e. if the bearer needs their deposit back before the deposit's maturity date, they can sell their investment. Then there are non-negotiable CDs. These pay a set interest rate, called a coupon, and repay the capital as normal. They cannot be readily sold by the investor. Repurchase agreements, also called repos, are where two parties agree to buy or sell an instrument at an agreed price and then repurchase back at an agreed price at a set time later. To the party selling the security and agreeing to repurchase it at a later date, it is called a repurchase agreement. But what about the buyer who are buying something that the seller promises to buy back from them in the future? Therefore, they will call it a reverse repurchase agreement. These can be very short term. Bank deposits. These are deposits made to a bank. You should already be quite familiar with these, and they were covered in the previous section, the nature and role of financial markets and institutions. Government securities are bonds issued by a government authority. These were also covered in the earlier section. Local authority bonds are fixed interest bonds that are repayable on a specific date, used by local authorities to raise a loan. These are similar to Treasury bond. A non-interest-bearing security traded on the money market would be a bill of exchange, which is an unconditional promise to pay a specific sum either on a future date or on demand, so it can be called in at any time. They can be sold to third parties after their creation. Discount instruments. Discount instruments don't pay interest to investors. Instead, they are sold at a discount to investors. So, for example, an organization issues a security of $100, available at a 20% discount. That means that it is being sold for $80. On maturity, $100 will be paid to the investor. The difference is the income for the investor. Unlike interest-bearing investments, where investors must wait to receive interest, investors can get their gain at the beginning when they buy the product. The following instruments are discount ones: Treasury bills, which are issued by governments at a discount on their face value. Commercial paper. These are issued by big organisations with a very good credit rating. They are unsecured for a short period of time, usually for 30 days or so. These organisations use them to fund short-term investments. Bankers' acceptance. These are issued by companies like commercial paper, but a bank guarantees them. They are guaranteed because the organisation may not have a good enough credit rating to offer a commercial paper. The guarantee makes them more secure, so the return offered will be low, but the organisation will have to pay a fee to the bank for that guarantee. These can be traded on the money market before maturity. Derivative products. I have already mentioned that they can be used to manage currency and interest rate risk, but what exactly are they? They are contracts between two parties. Their price is determined by an underlying asset. Assets such as currencies, interest rates, bond and market indexes. The value of the derivative is affected by fluctuations in the value of the asset. There are many different kinds of derivatives. Future contracts, or just called futures, are the most common. They are used to hedge against risk over a certain time. For example, ABC Limited is a UK company that is committed to buying a US shopping mall. They will need to pay $10 million in 1 year's time. ABC's currency is British pound sterling, and they want to use derivatives to manage the risk of dollars going up in value against their base currency, which is British pound sterling. They agree to buy $10 million for £8.5 million, which is the current exchange rate, from Z Limited. Z Limited speculates that the dollar will lose value over the next year and that they will make a profit on this exchange. After 1 year, $10 million is worth £9 million due to the sterling falling in value. This means that ABC has benefited from this forward contract and Z Limited has lost out. As well as future contracts, there are forwards. They are like futures but are traded over the counter and not on a stock exchange, often through dealers. Swaps are another form of derivative where two parties contractually agree to take on the other's, for example, loan liability. So if ABC Inc. is paying 5% fixed rate interest on a loan and they expect interest rates will go below 5%, they can swap their loan rate with QTZ Incorporated, who have a variable loan rate. The underlying loan agreements remain the same, but ABC will pay QTZ's loan and they will get a variable interest rate, and QTZ will pay ABC's loan. If interest rates go above 5%, ABC has lost out because they must pay a higher interest rate. And finally, options. These are similar to futures. The key difference is the buyer or seller can decide not to go ahead with the transaction if they don't want to. An option can be short, where an investor expects the value of the asset to fall. They sell shares of borrowed stock. This works by the investor borrowing shares from a dealer and paying interest for this loan. They sell the shares for the current market price on the open market, receiving cash for their sale. If the share price falls, they will then buy the same amount of shares back and give them back to the broker. The only cost is the interest they paid on borrowing the shares. If the shares increase in value, the investor loses out and owes the brokerage firm. A long option, in contrast, is where the investor owns the stock and expects the prices of the asset to rise. A call option gives the investor the right, but not the obligation, to purchase a stock or a bond, etc., at a specific price within a specific time. That means that the investor gains if the asset value increases from when they put the call in place, because they can access the asset at a lower rate. or a put option. This is the opposite of a call because it gives the seller of the asset, not the investor, the right, but again, not the obligation, to sell their securities at a specific price and in a specific time frame.